Every year for nearly 6 decades, Warren Buffett explaining what happened, what he learned, and what he got wrong. These letters have become the most influential investment writing of our time. They have shaped how generations of investors think about value, risk, capital allocation, and business quality. They have been studied, quoted, and analyzed more than most academic papers and investment textbooks combined. But here's what makes them truly remarkable: they are free. Available on Berkshire's website for anyone to read. No paywall, no subscription, no barrier between you and 60 years of compounding wisdom. So, what are the essential lessons? What thread runs through decades of letters that every serious investor should understand? Hello everyone, welcome back to our channel and welcome back to this video. This video is a part of our Between the Lines series, and today we are going to be discussing the Berkshire Hathaway shareholder letter. Let's start with owner earnings, the real measure. Buffett introduced a concept in his 1986 letter that cuts through most financial statement complexity: owner earnings. The formula is straightforward. Take reported earnings, add back depreciation and amortization, then subtract the capital expenditures required to maintain a competitive position. What remains is what the business actually generates for its owners, cash that could be extracted without damaging the enterprise. This matters because reported earnings often mislead. A capital-intensive business might show healthy profits while requiring constant reinvestment just to stay in place. A company with accelerating depreciation may look weak on paper while actually generating substantial distributable cash. Buffett returns to this concept throughout his letters because it forces investors to ask the right question. What do I actually get from owning this business? Not accounting profits, real cash that could fund dividends, buybacks, acquisitions, or simply sit in the bank earning interest. The discipline of calculating owner earnings also exposes quality. Businesses with high owner earnings relative to reported earnings typically have durable advantages. They don't need to constantly reinvest just to stay competitive. Businesses with low owner earnings relative to reported earnings are often running hard just to stay in play. Next, let's talk about the economic moats and competitive advantage. The letters popularize the concept of economic moats, sustainable competitive advantages that protect a business from competition the way a moat protects a castle. Warren Buffett identifies several moats across his letters. First and foremost, brand power. The ability to command premium prices because of consumer perception rather than product difference. Then there is network effects, platforms that become more valuable as more people use them. Then there are switching costs, the friction that keeps customers logged in even when alternatives do exist. And finally, the cost advantages, structural efficiencies that competitors cannot easily replicate. But the most important insight out there is how he evaluates the moat durability. A moat that exists today may erode tomorrow. The relevant question isn't whether a company has competitive advantages, it's whether those advantages will persist for decades. And this is why Buffett constantly favors businesses wherein the source of advantage is structural rather than operational. A brilliant CEO can create temporary advantages through superior execution. But when the CEO leaves, the advantage often leaves too. A structural moat, that is brand, network, regulatory protection, persists regardless of who is running the company. He illustrates this repeatedly with See's candies. The brand commands premium pricing in California not just because of superior chocolate. The chocolate is good, but because of generational associations with gift giving and special occasions, it commands its premium. That positioning exists in consumer memory, not just in any operational playbook a competitor can copy. Next, let's talk about Mr. Market and emotional discipline. Buffett borrowed the Mr. Market metaphor from his mentor, Benjamin Graham, but the letters extended to a complete psychological framework for investing. The metaphor. Imagine the stock market as a business partner named Mr. Market who shows up daily offering to buy your shares or sell you his. There are going to be some days when Mr. Market is euphoric, offering ridiculous prices. Other days he is depressed, willing to sell at absurd discounts. Your job isn't to follow his moods, it's to take advantage of them when they serve you. Warren Buffett adds to decades of letters is the emotional discipline required to actually behave this way. In theory, buying when others are fearful sounds easy. In practice, fear is contagious. When markets collapse, every news headline reinforces the fear and every conversation confirms the panic. Stepping into buy feels like catching a falling knife. The letters document Buffett's own behavior during crisis. 1973-74, 1987, 2008, 2009. In each case, he was buying aggressively when the prevailing sentiment was terror. Not because he predicted the bottom, he explicitly says timing is impossible, but because he focused on value rather than price direction. He also documents his mistakes, the times that he sold too early, held too long, or let fear override his analysis. This honesty about error is part of what makes the letters valuable. They are not victory laps. The letters are real-time documentation of decision-making under uncertainty. Next, let's talk about capital allocation as the central skill. Across all the letters, one theme emerges as paramount. Capital allocation is CEO's most important job. Not strategy in abstract, but concrete decisions about where to deploy cash. Buffett outlines the options available to any cash-generating business. Reinvest in existing operations if returns exceed cost of capital. Acquire other businesses if you can buy them below the intrinsic value. Return cash to the shareholders through dividends or buybacks if neither reinvestment nor acquisition offers adequate returns. Or simply hold cash and wait for better opportunities. What's striking out here is how few CEOs he believes allocate capital well. Most default to the reinvestment regardless of returns because growth feels like progress. Many pursue acquisitions that destroy value because deals are exciting and empire building is psychologically rewarding. Very few have the discipline to return cash when that's the highest value use. The letters are essentially a masterclass in capital allocation decision making. Buffett walks through acquisitions explaining exactly what returns he expected and why. He also discusses the retained earnings as a scorecard, wherein every dollar kept should create more than a dollar of market value. He admits when the buybacks were mistimed or acquisitions were overpriced. For anyone evaluating companies, this framework is essential. Don't just look at what a business earns, look at what a management does with those earnings. A mediocre business with exceptional capital allocation can outperform a great business with poor capital allocation over time. And this brings us to the long-term owner mindset. Perhaps the most distinctive aspect of the letters is their time horizon. Buffett constantly thinks in decades and not in quarters. This is not just rhetoric, it's reflected in actual behavior. Berkshire's holding period for core positions has averaged over 20 years. Some positions have been held for 50 years. The patience itself is a competitive advantage because it allows Buffett to buy assets that short-term investors are forced to sell. And the letters explain why this time horizon matters mathematically. Short-term trading incurs friction costs, commissions, taxes, bid-ask spreads. Each transaction reduces the returns. However, a long-term holder avoids all these costs and allows compounding to work uninterrupted. But the deeper argument is psychological. Short-term investors must constantly predict market direction, sentiment, and timing. Long-term investors only need to be right about business quality and valuation. The former requires forecasting the unknowable. The latter requires analysis of the knowable. Buffett explicitly argues that most investors would be better off making fewer decisions with more conviction. Buy wonderful businesses at fair prices that do nothing for decades. The urge to act, to trade, to respond to the news, these are the enemies of compounding. And this brings us to reading the letters today. The recent letters offer real-time applications of these principles. Buffett's Apple position exemplifies the mode framework. He identified a business with extraordinary customer loyalty, high switching costs, and a services ecosystem that generates recurring revenue. The position grew to represent a significant portion of Berkshire's value at a point of time, demonstrating concentrated conviction when analysis supports it. His recent investments in Japanese trading houses show the value framework in action. Established businesses with diverse assets trading at substantial discounts to book value, funded cheaply through yen-denominated borrowing. This is classic Buffett quantifiable value with a margin of safety. And the recent letters addressing succession planning demonstrate long-term thinking at ultimate level, positioning Berkshire to thrive for decades beyond his involvement. The letters remain relevant because the principles don't change even as markets evolve. Technology creates new modes, globalization creates new opportunities, but the fundamental questions, what is a business worth? What are the risks? How should capital be allocated? These remain constant. In closing, we can say that the Berkshire letters aren't a system to be followed mechanically, they are a thinking framework to be internalized. Buffett himself would be the first to say that copying his investments misses the point completely. What matters is understanding why those decisions were made, the analytical process, the psychological discipline, the long term orientation. Now, if you've never read the letter, start anywhere. Each year stands alone while connecting to broader themes. You'll find yourself returning to them throughout your investing life, discovering new insights as your experience deepens. The fact that all this wisdom is freely available from someone with arguably the greatest capital allocation track record in history remains one of the great gifts to serious investors. That's all that we wanted to share with you in this episode of Between the Lines. I'm Pallavi Sehgal, and this has been Between the Lines, the Berkshire Shareholder Letters. And if you found value here, subscribe for more deep dives into essential takes of investing and business strategy.